The case for single life plans. Here we are. This one's called the case for single life plans. Single life. Been working with a lot of clients recently, helping their mortgage advisors sell more protection. We do mostly selling skills or persuasion skills because life assurance and protection, critical illness, has to be sold. Now, problem we've got is a lot of people who are dealing with this product area are CMAP qualified. And CMAP hardly covers the topic properly, really. There is some changes afoot, which I'll share with you in a second. But what you're finding then in this marketplace is you've got a huge amount of first-time buyer activity going on now, haven't you? You've got the young couples all looking to buy property. There you go. And we've got a couple here, stereotypical couple. It could be opposite sex, of course, it doesn't really matter. But young couples looking to buy properties. Unmarried, so no civil partnerships, anything like that. And that's predominating the marketplace now, and with this 95% lending coming in, you'll find a lot of people, first-time buyers, will come back in. A lot of single people will buy in lower price areas, but in higher price areas, people tend to club together. People buying together, couples, just partners, whatever. So they can get a bigger mortgage and a bigger property. And they take out a mortgage, a joint mortgage, or whatever that looks like, and they get cover, they get protection, because protection advisors will swoop in and sell them the cover. So you're finding an awful lot of joint life cover being recommended. It tends to be the default for a couple, a married couple, yeah, but even an unmarried couple, a young couple living together, maybe going to get married, maybe not, doesn't really matter these days, does it? But they tend to go for this sort of default joint policy. And I don't know why that is. This is the worry. Is it because it's cheaper? Is it quicker? Is it less paperwork, less admin, less hassle? Is it just a knee-jerk reaction? You go joint, joint, joint every time there's a joint mortgage. And that worries me really for three reasons. And I'll share these with you. Number one reason is portability. So there's three big reasons here for you. Let's put them over here for you. Let's get a different colour pen. Portability. There we are. Now, portability or flexibility, call it what you like, it has gone, because if these people have a joint life policy, if they do go their separate ways, and we mustn't encourage that, because you know they're all loved up, aren't they? And some of these people, and you don't want to encourage any sort of split up notions. But if they do go their separate ways, a joint policy tends to get cancelled, and that's not a good thing. Whereas a couple of single policies would certainly go their separate ways as well. The other one, of course, is death, premature death. If the policy does pay out, which of course these things are designed to do, then the policy stops, because it does. The policy stops, therefore the people aren't covered anymore, and to get insurance they have to go reapply. They may be still young, so it may not be a problem, but that's a big issue. But the third big issue is taxation. Taxation. And people don't really appreciate the impact of this. It may not have an impact, but it might. And that's the consideration that you need to have. Now, let me explain how this works. As you can appreciate, of course, when somebody dies, what life insurance deals with, they have a potential inheritance tax liability. I say potential because there are a lot of limits now, and there's main residence exemptions and annual exemptions and stuff like that. But potentially, you see, when somebody dies, the value of their property falls into their estate on death. Now, it does depend on, of course, on how the house is owned. We sneak a property down here. Let's put the property there for you. There you go. It does depend on how the property is owned. If it's joint tenants or tenants in common, it does change. If it's tenants in common, of course, a share of the property will go into your estate and then get inherited, and that could, of course, enhance things. But you see, a lot of people don't know that even if the property is owned joint tenancy, a nominal share goes into your estate. So if this property is owned joint tenants, which of course means on death it goes to the other person automatically, the revenue take half of the property and nominally put that value into your estate on death. Not a lot of people know that. They give it a discount on market value, but they will put a value in there, even though it's gone to the other person automatically. So that's the first thing. Now, in addition to that, here's the rub, the life assurance policy that's set up, joint life policy, again, half of that, although all of it goes to the person that's surviving, half of that also goes into the estate, a nominal figure, a token figure, call it that. So you've got these two token figures, half of the property value and half of the life assurance value, nominally going into the deceased estate. And think about that for a second, because if you're in a high price area, so, I mean, the government's new 95% mortgage scheme lends up to 600,000, I think it is, a huge amount of money. So you could have the property, say 500,000, with a mortgage of say 400,000. So suddenly you've got 250 plus 2, you've got 450 grand nominally going into the deceased estate, which can cause an inheritance tax liability. Not a lot of people know that. And of course, this then is going to be inherited by the family. Unmarried couples tend not to have made wills. They should do, of course they should. But invariably they're unmarried, so the law of intestacy kicks in. The money therefore goes to the next of kin, which probably is the parents. So the parents have got an IHT bill to pay. So they're going to get well upset about that. So it's big implication, this one. Now, of course, the parents might decide, well, who gave that bad advice? And they might sue you. Don't get these claims management companies now hovering around like vultures looking for the next big topic, aren't they? Because they ain't got much work at the moment. So they will pick up on this sort of thing. I can see it happening. And therefore you'll be sued accordingly, and you don't want that. All because you gave the wrong advice. Think about that. That's big. Now, you may not have known that because CMAP never taught you that. CMAP syllabus didn't go that far. It mentions inheritance tax and stuff like that. Of course it does. But the answer is quite clear, and I put this in red. The answer, as you can appreciate, is 2 single policies. You want 2 single policies rather than the joint policy for unmarried couples. Full stop. Make that your default. Here, obviously, you put them into trust. Of course you would. So that the money goes to the other party on your death. Of course you would want to do that. And this kind of solves all the problems, really, because you've got money going into each other. There's no half policy, of course, to go into the estate. Money goes to the other person to pay off the mortgage. On portability side, they go off their separate ways anyway. On death, there's another policy remaining, and the taxation issue is at least halved anyway along the way. And I think that's a really good thing. You could do life of another. Life of another is where you set up a life policy on the life of somebody else. You own the policy and it's somebody else's name, which you can do as well. That's an option, but they've pretty much died a death in the 20th century, really. Excuse the pun, died a death. They tend to be pretty inflexible and not really what we recommend. Nowadays we tend to go for the trust version.